We are discussing the chapter options in derivatives. In the last class, we completed the discussion regarding the minimum value and maximum value of the call and put option and the arbitrage process if it is below minimum or above maximum value. Today, we will discuss a concept called as put-call parity equation. That will be the first concept to be discussed. The arbitrage, if the put-call parity is not satisfied, will be the second discussion we will be making. We will also discuss the option valuation models. We will try to complete one model today called as binomial model for option valuation. So these are all the issues we will try to cover in today's class. Before I proceed further, let us summarize what is done in this chapter, options till now. See, option is a contract which gives a holder a right and a writer, it imposes an obligation. So this option can be of two types, call option and put option. Call option gives its holder the right to buy an underlying asset at an agreed price called as strike price on a maturity date. For getting that right, the holder pays the writer an option premium. Put option gives its holder the right to sell an underlying asset at an agreed price called as strike price on a maturity date. Again, the holder pays for the option a premium to the writer. There are three prices of the underlying asset: the spot price, the strike price and future spot price. Spot price is the price at which the underlying asset is traded in today's market. The strike price is the agreed price for a transaction to take place tomorrow, today itself. And the FSP is the actual price of the underlying asset on the maturity date of the contract. So the option will be exercised or lapsed based on comparing the strike price and FSP. Always a holder decides, the writer obeys. So in case of call option, if the FSP more than strike price, future spot price more than strike price, holder will exercise or lapse? Exercise. I have a right to buy at 90 rupees, a share worth 100 means I'll always exercise. FSP less than strike price means the holder will allow it to lapse. In case of put option, the FSP less than strike price, the holder will exercise. FSP more than strike price, the holder will allow the option to lapse. When the option is exercised, it is said to be in the money, and indifferent it is said to be at the money, lapse it is said to be out of money. The options can be of two types, American options and then European options. European option can be exercised only on the maturity date. American option can be exercised anytime during the maturity period. Then we discussed that how a call option payoff looks like. Call option gives its holder an unlimited profit. The loss to the holder is restricted to his premium paid. Put option, say call option writer will be having a limited profit to the extent of premium, but will be having a chance of having an unlimited loss. Put option holder earns a profit. The maximum is break-even FSP profit, and the loss is restricted to the premium. Opposite for the put option writer. The FSP at which they earn zero profit is called as break-even FSP. Break-even FSP is equal to strike price plus premium for call option, strike price minus premium for the put option. Last class a doubt was asked once again by number of students, sir, why we say plus premium for call, minus premium for put? It's a very simple logic. Now, strike price for a call option is a purchase price for the holder, yes or no? Holder purchases at what price? Strike price. And the purchase price is inflow, outflow. Premium is inflow, outflow or outflow. So he added the two outflows, so it is strike price plus premium. These two outflows should be recovered by his selling price called as FSP. In case of put option, the strike price is the selling price. The reason is having a right to sell at the strike price. So in that case, the strike price is an inflow. The premium is an outflow. Outflow should be added to inflow or subtracted or subtracted. It is strike price minus premium. Maximum I can pay for FSP for me to have a zero profit. So this is regarding the break-even FSP concept. Then we discuss about the various option strategies. Very routine area is what is a long straddle, a short straddle, long strangle, short strangle, bull spread with call option, bull spread with put option, bear spread with call option, bear spread with put option, butterfly spread with call option, and put option also can be created. These are all the various strategy which has been discussed. There we have lot of cash flow patterns or payoff patterns. That is nothing great, only have to be revised, that's all. Okay, next. Then we started discussing the main area, option valuation concepts. Further we discussed first the concept called as continuous compounding. When you compound continuously, future value is equal to present value into e power TR, where the R is the rate of interest per annum, T is the period expressed in years. And here e raised to something e power x, how to calculate? 1 plus x power 1 by 1 factorial plus x squared by 2 factorial plus x cubed by 3 factorial, or 1 plus x power 1 by 1 plus x squared by 2 plus x cubed by 6 gives you the continuous compounding factor. Discounting means present value is equal to future value divided by e power TR. How they write is future value into e power minus TR is going to give you the present value. Then we started discussing about the option valuation concepts. Please. Now, then we started discussing about the option valuation concepts. Stop talking. See, we saw that share as a value, that is we value the share on our own and then compare the value with the market value or market price, identify the share as underprice, overprice, and then decide to buy or sell. Right or not? Bond as a value, we value the bond on our own, we compare with what? The market value. See the bond is overpriced or underpriced, and then decide to buy the bond or sell the bond. Like that every asset, this is the criteria. We should know to value an asset and then compare that value with the market value and then decide whether the market value is underpriced or overpriced and then go for the buying or selling decision. Right or not? No. So the value is nothing but the price we are willing to pay for a given asset. Like that. What is the price I want to pay for an option? It is called as what? Premium. I want to know what is the right option premium and compare with the market option premium and then decide option is underpriced or overpriced. Suppose the option is undervalued. The option is what? Underpriced. Then I'll buy the option or sell the option? Buy the option. When I go to the F&O market and click a buy order for an option, I am said to be what? Holding an option. Suppose I have a premium which is overpriced, the market has overpriced the option, I'll buy it or sell it. Sell the option. In that case, I become what? A writer of the option. Okay. So you can either go and pay a premium, become a buyer of an option, or receive premium and become a writer of an option. So how I buy and sell share for a share price, I can buy and sell option for an option premium. In real world, what happens is, see, today I may buy a call option at 6 rupees premium. Tomorrow same call option selling at a premium of 7 rupees means what? I can sell and come out. How I trade in shares? I can also trade in what? Options. That's how the real option market works. Can I proceed further or not? Now. So here first we saw what should be the boundary within which the premium should be there. Okay, we want to discuss first about the theoretical boundary for an option price or option premium or option value. Whenever you use the word value, premium, price, all are what? Same. Okay, now what is the theoretical boundary? We have 4 discussions. Minimum value of a call option, maximum value of a call option. Minimum value of a put option, maximum value of the put option. 4 sums we did. Respond, yes or no? Now, tell me first, what is the minimum value of a call option? Everybody. Spot price minus present value of strike price. What is the maximum value of a call option? Spot price. What is the minimum value of a put option? Present value of strike price minus spot price. What is the maximum value of the put option? Present value of strike price. I think all able to recollect or not? Now. So here, if it is below minimum, above maximum, what exists? Arbitrage exists. Now, tell me the strategy. This will never change. Okay. Below minimum, call option is trading below minimum in the market. Call is theoretically what 20. It is trading in the option market at 10 rupees. Call option is underpriced or overpriced? Underpriced. What you will do? Buy the call. When I buy the call option, tomorrow what I am going to do with the share? Sell the share. Today what I should do? Tomorrow what I am going to do? Buy the share. Today what should I do? Sell the share. I call it as what? Short sell. Can you tell me the strategy together? Short sell the share and buy the call is a strategy. Yes or no? No. Next is call option is overpriced. That is, it is above maximum. The actual value in the market is above the maximum. Okay. In that case, call is over or underpriced? Overpriced. What you will do? I am going to what? Sell the option. Selling the option means what? Writing. So the strategy is write a call. I am a writer of a call means tomorrow I am going to buy that share, sell that share, sell that share. Writer of a call is having an obligation to sell. So today what I should do? Buy the share. Can you tell me the strategy? Write a call and buy the share. Enough for it or not? Now, the third is going to be the put option. Minimum value of the put option. Below that the actual value is there. If the actual value is below minimum value, tell me put is under or overpriced? Underpriced. What I will do? Buy the put. A buyer of the put option is having a right to sell tomorrow. What will you do today? Buy the share today. So tell me the strategy. Buy the share, buy the put. Strategy alone is a bachelor strategy. All others are what? Married strategy. So no, because all are having two item. One in share market, one in option market. For the last alone, only option market enough to get the strategy. If you are going to short sell the share, no problem getting what? Much more bumper profit. But it is enough if you simply want. Write about for the last strategy. For all this, the problems have been done. Everybody following or not? No. See, one request is, this chapter will be looking like this only, because for teaching an option chapter, we don't require English language at all. Okay, I don't require funda English language. I don't need to be a Shakespeare to what? Teach this. Reason is vocabulary very limited. If you see the past 3 or 4 classes, I use only the following word: call, put, FSP, strike price, spot price, exercise, lapse, value of call, value of put, pay of premium. Use tell me. I have not used any other words. So no, they will be what? They are doing the same words. Risk is, if you don't revise and come, you will be lost in the forest. You will be lost in what? The forest. Because we don't know where we are discussing. That agility will be what? Missing. You will be coming prepared to this particular class. I, from my part, tell you in different angles, same thing again and again, but ultimately you should be agile in each and every discussion. I'll say, till the chapter completes, this is how it will be looking like. Everybody following or not? Because it is like a very concentrated chapter. Portfolio means it is a very open-ended. We keep on discussing concept by concept. This very concentrated chapter revolving around what? Few concepts, but very deeply. Everybody following her? Now. Now we are going to go for the next concept called as put call parity. In IFM, we had a parity. What is the parity? Purchasing, important interest rate parity. Around that only money market hedge, then euro rates, all the other covered interest arbitrage, everything was built around. Yes or no? The backbone of that chapter was what? Interest rate parity. Same way here we are going to have a parity called as put call parity, a very, very important equation we are going to discuss. So now we will start with a discussion about the concept called as put call parity. Okay, now I will discuss the equation along with its derivation. Okay, once it is over, I'll give you the notes in this regard and then start doing problems in this regard. Okay, now see, let us take for example a company TCS. Okay, let's take a company TCS. For TCS, in two markets, there are three instruments that are getting traded. Okay. For example, for TCS in share market, what is trading? TCS shares is trading. In the option market, what is trading? TCS call option, TCS put option. Okay, so tell me how many securities are there for TCS? Three securities. What three securities here? TCS share, TCS call, TCS put. All the three are trading at their respective prices. Is or no? No. We go to the share market and the TCS share is supposed trading at 2,000 rupees. What I can do? I can pay 2,000, buy the TCS shares. I can sell the TCS shares, receive what? 2,000 is a share market price and the transaction. Yes or no? I go to the option market. Suppose a TCS call option is trading at 60 rupees or what? 70 rupees. The meaning is what? I can pay 60, buy a TCS call, or I can what? Receive 60 and sell a TCS call option. Same way put option will be having yet another price at which it is trading. I can pay the premium or receive the premium and hold the put option or write a put option. Everybody yes or no? So now we know that for a given company in two markets, there are three securities that are getting traded. Respond yes or no? Yes, that means all the three should be having a link in their value. They are not independent here. All are what? The securities of the same company. All the securities of what? Same company. So, what we say is, TCS call option, TCS put option. Two contracts are or not? Yes, sir. If both call and put are having the same strike price, as going on, same strike price. Not that the TCS call option is for a strike price of 2,300 and put option is a strike price of what? 2,100. Not so. TCS call option and put option, both these contracts should be for the same maturity price. Should be for what? Same strike price. Point number one. Understand or not? Next, point number two. Both the TCS call option and put option is having the same maturity date. Now that one is a 3 months TCS call, another is what? 4 months TCS put. Not so. The two options are having what? Same maturity date. So that means the call option, put option, both are on the same share. Called as what? TCS shares. They are both on what? And the same strike price, they have what? The same maturity date. If this is the case, then the call option price, the put option price and the share price should satisfy an equation called as put call parity. Everybody following or not? The background, now again I say, what is that? How many assets are traded? Three assets. Name the three assets. Share, call option, put option. Call and put options are on what? A given share. Okay. If the call option and put option is on the same underlying asset, is on what? Same underlying asset. It's not that Infosys call option, TCS put option. I don't compare that. It is not comparable. I'm saying what? Call option of the same underlying asset. Point number one. Okay. It is not that one is having a high strike price, another is having what? Low strike price. Both has what? Same strike price. So same strike price, same underlying asset. One is not a 3 months call, another is not a 4 months put. Both are having what? Same maturity date. In that case, the call option price, the put option price and the share price, they form a triangle. They should satisfy a parity called as what? Put call parity is the point number one. I just wanted to communicate. Everybody, are you following what I'm saying? What is a put call parity equation? This is the put call parity equation. It is VC plus PV of X is equal to VP plus VS. Okay. So what is the equation? VC. What? Okay. Value of call plus present value of strike price is equal to value of put plus value of share. Okay, now this is the equation. Now, we'll come to the derivation later. Let us just understand what this means. Okay, see. Value of call, value of put, value of share. This is price of call option. This is what? Price of put option. This is the price of the share. These three numbers can be obtained from the market. I go to the share market and the share TCS share is trading today at how much rupees? 2,000 rupees. So what is the value of the TCS share? 2,000. Respond is or no? Now. I can go and get the call value from what market? Option market. Today the TCS call is trading at a price. It is called as what? Value of the call. Even called as call premium or the price of the call. Yes or no? Like that. This also can come from what market? Option market. The put is trading at this particular price. Everybody yes or no? And this call and this put both as what? The same strike price. Both have the same strike price. The strike price is after the maturity period. If I discounted, the present value also should be what? Same. The reason is very simple. Both have the same strike price. Both have the same maturity. So the present value should be what? Same, obviously. Respond yes or no. Now, what they say is, you take the call option price, put it here. Suppose a call option price for an example for an asset is 10 rupees. How much is here? 10 rupees. Okay. You see the strike price of the two options, call option then what? Put option. Calculate the present value. Suppose the present value is 80. What present value? How much here? 80. You take the put option price. Suppose the put option price is suppose 8 rupees. What put option price is going to be? 8 rupees. And you go to the share market, you see the share price. Suppose the share price is 82 rupees. The share price is what? 82 rupees. In that case, the prices are satisfying. The prices are what? Satisfying. Something called as what? Put call parity, because left hand side also 90, right hand side also is what? 90. Suppose, are you following what I am saying? Suppose, in the share market, if one of them is different number, share is not trading at 82, share is trading at what? 85. In that case, what is absent? Parity is absent. So arbitrage will be present is what they are trying to say. Are you following what I am saying? In what I try to tell is, there's a call price, there's a put price, there's a share price, there's a strike price for the assets. Yes or no? All the four, if they have to satisfy this particular equation, if they don't satisfy, then the three prices are not proper in the market. The market is either underpricing or overpricing one of the assets. In that case, we have an arbitrage. That is what we call as a put call parity arbitrage. Everybody, are you understanding the background discussion or not? Now, so earlier last class, we discussed options independently. Call should not fall below minimum. Call should not fall above maximum. Put should not fall below minimum. It should not fall what? Above maximum. If it happens independently, they have what? An arbitrage. There we view the options independently. So no. No. Then we now integrated. Okay. There's a call, there's a put, there's a share. These all the three are from the same group of assets. Yes or no? In that case, they should be having an interlink of the values. Right or not? So the three values should satisfy the parity. If they don't satisfy the parity, the market will immediately what? Jump in and then make a riskless profit. That is what we call as a put call parity arbitrage. Now, the question is, sir, what is this equation? How it has been arrived at? What is why it is called as VC plus PV of X is equal to VP plus VS. Now we are going to understand the meaning or the derivation of this equation first. Okay. Once we understand this, next stage we will be doing a problem where question will give you value of call, value of put. Ask you to find out the value of share as a missing figure and vice versa. Two numbers given, third number should be found out. Third will be given share value, call value, put value actually from the market. Ask you to test whether there is a parity or not. If not, ask you to find out the arbitrage strategy will be the third stage of discussion. These are all the issues I'll be discussing in this area called as put call parity equation. Can I start with our discussion or not? No. Okay. Before that, tell me the equation first. What is the equation? Value of call plus present value of strike price is equal to value of put plus value of share is a put call parity equation. Can I proceed or not? No. Value of the call, again I just again say, just to have a confirmation, value of the call is nothing but premium for the call, where you can get from the option market, where you can get the value of the put option market, where is the value of the share market. All are the today's value of these three items traded in the market. They should satisfy the parity. Can we start or not? Now let's understand this with the help of two portfolios. Okay. Now what is a portfolio? Tell me. What a portfolio? Group of assets. If I hold what a group of assets, I am certainly having what? A portfolio. Can I proceed? Now, please. I am going to have two portfolios. Portfolio 1. I am going to have what? A portfolio 1. These are all natural portfolios. Okay. Now, what is this portfolio 1? I am having a call option. I am going to purchase a call option. I am going to purchase a call option. I am also going to keep some cash. Very simple. Why should I have some cash? Then only on the maturity date, if I exercise a call, I'll be having a money to buy the share. Now, so a call option holder should be having in his hand what? A cash. Because having a right to buy on the maturity date. So he'll be having some cash in hand today. Okay. So this is one portfolio. What is the portfolio? One, call option, and then what? Cash. Hold a call and deposit some cash. How much cash should I deposit? I should deposit enough cash that gives me strike price on maturity date. Yes or no? Suppose I have a right to buy at 100 on maturity date. I should be having 100 on the maturity date. Yes or no? Today should I deposit 100? Less than 100? Less than 100. How much deposit? Percent value of the strike price. So I am going to have two assets in my hand in portfolio 1. Name the two assets. Option and then what? Cash. Option asset only. Yes or no? Very simple. I buy a share. Share is an asset or not? I buy an option is also what? Asset only. Yes or no? It is also having a price that could also be sold tomorrow. Are you following what I am saying? No. So now tell me, portfolio 1, I am having two assets in my balance sheet. What are two assets? A call option and then what? A cash. A cash deposited. How much I cash deposited? Present value of strike price. Respond yes or no? No. So hold a call and then what? Deposit cash enough to have on maturity the strike price. Otherwise the present value of strike price. Okay. Now this is the portfolio. Now forget this. I'll ask a question. Answer it. I'll come back to this. Okay. Now today I buy a TCS share. Today I buy what? A TCS share. And I also have a cash. Tell me in my balance sheet what are two assets? Share and then what? The cash. What is the value of the share? What is the value of the share? Its market price today. Today the TCS share is trading at 2,100 rupees, means the balance sheet value of the share is what? 2,100. Always I said I'll discuss about the market value balance sheet. Respond yes or no? No. Suppose you are holding a TCS share. You're holding a TCS share. You're holding 10,000 rupees cash. Tell me what is the portfolio value today? The price of the TCS share and then what? The cash in hand. Yes or no? Same way, I am not holding a share. I am holding what? Option. Tell me what is the value of the portfolio today? The value of the option. Today the option is trading at a price in the option market or not. So the value of the option plus what? The cash, present value of the cash will be the wealth of me today. Yes or no? So today my wealth is, I am having two assets. What are two assets here? Call option and then what? The cash equal to what? Present value of strike price. So if I total my balance sheet asset side, what is the balance sheet asset side total here? Value of the call. The call option will be trading at a premium today. If you want, I can sell at the premium, get the money as cash. So no, in that case, I have a call option premium, which is called as what? The asset value of call plus what? The cash. So the value of my portfolio today is VC plus present value of strike price. Are you all following what I am saying? This is the value of the portfolio 1. Now, what is a portfolio 1? I am holding a call. I am also holding some cash. What is the value of the call I am holding? VC. Where I can get this number from? Option market. What is the value of the cash I am holding? Present value of strike price. What is my wealth today? VC plus PV of X. Suppose I am wound up today. If for example, I am becoming insolvent, court ordered me to what? Sell all my assets. So what I can realize here? I can sell my call for a VC. I can also what? Realize a PV of X. And then I am going to settle my creditors, etc. Just simple way of understanding it. So my wealth today is VC plus PV of X. Is portfolio 1? Yes or no? Now, this is one portfolio. Let's go for another portfolio. Now, in the second portfolio, I am not holding a call, I am holding what? Put option. Now, holder of the put option will have a right to sell the share tomorrow, yes or no? Yes, so put option holder should be having a cash or share. Because when you want to exercise, he doesn't require cash. He requires what? Share to sell it. You know what I am saying? In that case, the natural portfolio for a put option holder is what? Holding a put, also what? Holding a share which can be delivered if the put is exercised. So this is the portfolio of the put option. Yes or no? In that case, hold a put, hold an underlying asset for delivery when the put is exercised on maturity date. Accepting it or not? Now, in that case, tell me, I am holding how many assets here? Two assets. One is a put option, another is a share. What is the value of a put option? VP. What is the value of the share? VS. That is the spot price of the share. So the second portfolio value today is VP plus VS. No. My aim is to prove that VC plus PV of X will be same as what? VP plus VS. Then put call party is satisfied. Yes or no? This is proof. This is going to be what? Proof. The two portfolios should be having what? Same values. Only when both are having what? Same underlying asset, both having what? Same strike price, both have the same maturity period. That's the issue. Everybody following what I am saying? So now tell me, I am discussing about two portfolios. Can you tell me what is the first portfolio? I am having a call option, I am having a cash equal to present value or strike price. The call option today is worth how much? VC. The put on the cash is how much today? Present value of strike price. Portfolio 2, I am having what? Put option. And then what? Share. What is the value of the put option today? VP. What is the value of the share today? VS. So what is both these portfolios should be having the same value if they are on the same underlying asset, same strike price, same maturity period. Can I proceed or not? Now, very simple proof. Can I proceed? Now. Okay, let's take on maturity date. Suppose both are after 3 months. Okay, on maturity date, let's take portfolio 1 first. Okay, two things can happen on maturity date here. What are two things can happen here? FSP can be more than strike price. FSP can be what? Less than strike price. Same story again. Written order. The actual share price can be more than the agreed price. Can be what? Less than the agreed price. Always. Yes or no? No. FSP can be more than strike price. FSP can be less than strike price. Now, how many assets I am having? Name the two assets. Call and then what? The cash. Okay. Now, both assets will have a value on the maturity date. Both assets should be having what? How they have a value today? What is the value today? VC plus PVFX. Like that, both these assets, cash and what? The option should be having some value on the maturity date. In the parida no. So let's see what is the value of the call option. Now tell me. On maturity date, will you exercise the call lapsa? First case, FSP more than X. Exercise or lapsa? Exercise. Why exercise? I have a right to buy at a lower strike price. A share worth what? Higher FSP. I'll exercise or lapsa? Exercise. When I exercise, what I will do here? I will pay what? X. I will receive what? FSP. That means the value I get is FSP minus X. We wrote as VC in all the strategies on the maturity date. So on the maturity date, what is the worth of the call? Worth is nothing but benefit. Worth is nothing but what? Benefit. On the maturity date, what is the worth of the call here? The call gives me a right to buy at strike price. A share worth what? FSP. So what I get is FSP. What I give is what? A strike price. So the call gives me a value, a benefit of what? FSP minus X. Right or not? Now, suppose FSP is what? Less than strike price. FSP is what? Less than strike price. When I exercise or lapse? Lapse. When the call is lapse, what is the worth of the call? Nil. The call is worth what? Nothing. The call has become worthless. The entire premium is what? Waste. The call has become worthless. It is nil. Yes or no? This is the value of one of my asset call as what? Call option. This call option can be worth FSP minus X, or the call option can be worth what? Nothing. Or the two possible values for the call option on maturity date. Yes or no? No. Like that, I have only call. I have also cash. Today, deposit how much cash? Present value of strike price. On the maturity date, it will be PV of X, because the PV of X matures to what? X. So on the maturity date, it does not depend on FSP and all. What is the maturity amount of PV of X? X and X. Yes or no? I have only call, only cash and call. So my portfolio value is FSP minus X plus X gives you what? FSP. Nil plus X gives you what? X. This is the portfolio value on maturity date of portfolio number 1. Innappa, right? Innappa, yes or no? Now. So this is number 1. Okay, now. I'll just write it for you to get convinced. Now tell me what is the first item? FSP, second is what? X. Now. Two situation, FSP greater than X, FSP less than X. Now, I'll write portfolio 1 value. I just write the conclusion. Portfolio 1 value. What is portfolio 1 value? FSP. What is portfolio 1 value? X. Everybody, yes or no? Now, this is no rocket science. Very simple. On maturity date, if FSP is more than strike price, I'll exercise or not? Yes, the cash become what? Share. So my worth is FSP. If on maturity date, if the FSP is less than X, what I will do? Lakhs. So my cash will remain as what? Cash. The value is what? Strike price. Is that right or not? Is that correct? Huh? Very simple. Yeah? Now, call will not be there after maturity date. Call dies on maturity date. After maturity date, only cash will be there. Yes or no? The cash can be with me as cash, or can it become what? Share for me. Yes or no? In that case, FSP more than strike price. I will keep the cash, make it as a share. I'll use a call, make the cash into what? Share. What is the wealth of the share? FSP. On that day, the price of the share is what? FSP. That is my wealth. Yes or no? If it is less than the strike price, I'll exercise and lapse. I'll rather keep the money as cash rather than convert it into what? Share. In that case, what is my wealth? Yeah, strike price. So this is the simple meaning of the aforesaid portfolio. Can I proceed or not? Now. Can I go to the next stage? Now. I have another portfolio. What is the other portfolio? That is put option and what? Shares. Now everybody, same two situation. FSP greater than X and less than X. Are you following? Huh? Okay. You choose put option. FSP greater than X. Exercise and lapse. I have a right to sell at strike price. A share worth what? Higher money. Okay. Will I sell? Will not sell? Will not sell. Lapse. So the put is worth what? Nothing. Put is nil. Second case, FSP less than strike price. Exercise lapse. I have a right to sell at a higher strike price. A share worth what? Lower FSP. I'll sell or not? No. What is the benefit the put gives me? It gives me X. A share worth what? FSP. X minus FSP. Yes or no? No. I'm also having a share or not? Today the share price is spot price. What is the share price on maturity date? FSP. So the value of the share is FSP. Today the value of the share is VS. So no, the value of the share is today's spot price. After 3 months, what is the value of the share? The future spot price. Today what is the value of the share? Today what is the value of the TCS share? 2000. Trading in the market. So no, what is the value of the share after 3 months? At the price at it, TCS is trading after what? 3 months. Is that answer? In that case, it's going to be what? FSP. Are you following up? Now. So now, I am holding putta, shara, put and shara. Put and shara. Tell me what is the portfolio value? Nil plus FSP, FSP. X minus FSP is FSP gives you what? X. Everybody is so no. Now. This is very simple. After maturity date, 3 months, option will die. Two things can happen. Number one, the share which I am having, I can continue to hold that share. Yes or no? Or the share which I am having can be converted into what? Cash by selling it. Okay. If the put option is lapse, I continue to hold the share worth what? FSP. If the put option is exercised, the share goes out. It becomes what? A cash equal to what? Strike price. So my value can be FSP or what? Strike price. No. So can I proceed? Now this is portfolio 1 or portfolio 2 or portfolio 2. First case is what? FSP. Second is what? Strike price. So FSP and then what? Strike price. Everybody following or not? Now in that case we can say that maturity value of both portfolios are same. FSP more than X. What is the value of the portfolio? FSP. This portfolio also FSP. FSP less than X. What is the value of the portfolio? Strike price. What is the value of the portfolio? Strike price. So on the maturity date, the value of the portfolios are same only. Yes or no? If the maturity value of the portfolio is same, the present value also should be same. If the future value is same, the present value also should be what? Same. Hence the put call. What is the present value of the portfolio? VC plus PV of X, and what is the other portfolio? VP plus VS. If the maturity value of the two portfolios are going to be same now, then the today's value also should be necessarily what? Same. You may ask us why? Why is that today value should be one same? Very simple, yeah? Now, maturity value is FSP strike price. Now, when you want to find out the present value of that portfolio today, tell me it is on different share, same share. That means the FSP should be having the same spot value. What about? They are having a same strike price, different strike price are same. This strike price also same, this strike price also what? Same. This is not 90, this is not 100. Yeah, both are what? 100 only. So the present value should be what? Same. Strike price is what? Same. Are you following? Now, you can see now. look at this, look at this. This is a situation. This is what? Situation. What is the value of portfolio 1? FSP. What is the value of portfolio 2? FSP. If I discount both to today, both should be having what? Same value. Why? Because this is also same share, this is also what? Same share. If this FSP is 120, this cannot be what? 130. If this is 120, this should also be what? 120. The present value should be same. Yes or no? Now, or if this is a situation, what value of this portfolio? Strike price. What value of this portfolio? Strike price. There's two strike prices are same or different are same. If the strike prices are same, the present value also should be what? Same. Now you want to say, this amount is for 6 months. This amount is for what? 3 months. Then the present value can change. So no. But both having what? Same maturity period. The present value should be what? Same only. See, they are on the same share. So the FSP number should be same. They are having what? Same strike price. The strike price number should be what? Same. They have the same maturity period. The discounting period also is what? Same. And the present value should be same. Yeah, correct? Suppose 100 rupees strike price, this is also 100 rupees strike price, this is a 4 months call, this is what 3 months call now, this maturity value is after 4 months, is after what 3 months, then the discounted value can change, yes or no? This is a TCS share, this is an Infosys share, now the FSP will change, period may be same, the present value may change, yes or no? Strike price different, the present value can change. But the strike price also same, the FSP also same, the term also same, the present value also will be what? Same. So if the portfolio has got the same value on the future day, it will be having what? The same value today. Yes or no? What is the value of the portfolio 1 today? VC plus PV of X. What is the value of the portfolio 2 today? VP plus VS. That means what? VC plus PV of X should be equal to what? VC plus VS. Put call parity is proved. Everybody following or not? On the side, should I repeat? Can I proceed? Can I proceed or not? No. This we call as a concept of put call parity equation. Okay, now let's consolidate. Let us have a notes and then go to the next stage of discussion. See, now tell me, I am constructing 2 portfolios. I am constructing what? 2 portfolios. Can I name the 2 portfolios? Portfolio 1 is what? Tell the asset name. What are 2 assets in portfolio 1? Call option, cash. What are portfolio 2? Put option, share. What is the call option value today? VC. What is the cash value today? PV of X. That much cash I am having. PV of X. What is the put option value today? VP. What is the share value today? VS. So portfolio 1 value today is VC plus PV of X. Suppose today I sell everything. What I get in my hand? VC plus PV of X. What is the value of the portfolio today? 2 today, VP plus VS. Okay, now these 2 portfolios are having some value today or not. What put call parity says is that the 2 portfolios should be having what? Same value today if the call and put in the 2 portfolios are on what? Same share. If the call and put is on what? Same maturity date. Should be having what? The same strike price. And the asset should be also the same asset. Then the parity should be satisfied. That only we proved. Yes or no? Now, how we proved? Very simple. On maturity day, portfolio 1 has got 2 assets. One is what? Call. Another is what? Cash. The call option, FSP more than X means what? Exercise. I'll exercise and buy the share at how much rupees? X rupees. Worth how much? FSP. What is the worth of the call? FSP minus X. Second case, allow it to lapse. Out of the money call is worthless. Yes or no? Next. The cash today PV of X becomes what? X. If I total the portfolio value becomes FSP and then what? X. Same as second portfolio, what happens? Put option. Exercise or lapse are lapse. What is the value of a lapse put option? Nil. Second case what? Exercise. Sell at X, share worth what? FSP. X minus FSP. The share price today is spot price, later becomes what? Future spot price. If I total the value of portfolio is FSP and strike price. The both portfolios has got the same maturity value. So no, if they have the same maturity value, the present value also should be same. Why? Because same maturity value, the maturity value can be what? FSP or X. Both the same FSP, same strike price. In the same underlying asset or same strike price or no. And the discounting period also is what? Same. The reason is what? Same maturity period. Then the present value also should be same. Hence that exists a put call parity equation. Everybody yes or no? So this is VC plus PV of X is equal to what? VP plus VS is a put call parity equation. Understood or not? Now, can I proceed further? Now, let's start writing the notes in this regard. before you go for the problems. Now, full clarity irga? Now. Write down put call parity equation. Please. Point number 1. Never? AC off. Okay. Can you shut up? Now, write down point number 1. There are 3 securities trading in the market. There are 3 securities trading in the market. There are 3 securities trading in the market. Namely point A, share. Point A, share. Put a hyphen and write trading in what? The stock segment. Trading in the share segment. Trading in the share segment. Trading in the share segment. B. B is what? Call option. B, call option. Trading in what segment? F&O segment. Trading in F&O segment. F&O means what? Futures and options segment, derivative segment. Trading in F&O segment. C. C is what? Put option. C, put option. Put a hyphen and write trading in what segment? F&O segment. Trading in F&O segment. Okay, can I put the next point or not? Now, there's an Infosys share trading. There's a TCS call with a strike price of 100. TCS put a strike price of 80. Am I speaking about all these 3? No. I am going to speak about one combination, which is going to be the next point. So, no. Point number 2. If the call and put option, are on the same underlying asset, now option will be always on asset, yes or no? If the call and put option are on the same underlying asset, comma, having the same strike price, and with same maturity period, then the share price, comma, the call value, and put value. Then the share price, the call value, and put value should satisfy. Then the share price, the call value, and put value should satisfy put call parity equation. Should satisfy the put call parity equation. Can I proceed? Next. Point number 2 or 3? 3. What is the put call parity equation? Point number 3. What is the put call parity equation? I said they should satisfy, no? Now the question is, what is that equation? No. What is that put call parity equation? Question mark. What is the put call parity equation? Right below that, the equation, copy this. Write down VC plus PV of X. Equation is VC plus PV of X is equal to VP plus VS. VC plus PV of X is equal to VP plus VS. Can I proceed? Now, VC, put a down and write. What is VC? Value of call today. What is VP? Down and write what? Value of put today. Vs is value of share today. Vs is value of share today. Can I proceed or not? Now, point number 3 or 4? Point number 4. Understanding the put-call parity equation. Point number 4. Understanding the put-call parity equation. Understanding the put-call parity equation. Point number 4. Understanding the put-call parity equation. Underline that. In the right, A. Point A. Let us consider two portfolios. Let us consider two portfolios. Branch it into two. I'll dictate right along with me. Branch it into two. Let us consider two portfolios. Branch it into two. First branch. Hold a call. Hold a call and deposit. Hold a call and deposit cash. Hold a call and deposit cash equal to present value of strike price. Hold a call and deposit cash equal to present value of strike price. Hold a call and deposit cash equal to present value of strike price. Go to the second branch or the portfolio 2. All of you tell and write what is portfolio 2. Hold a port and hold a share. Portfolio 2, hold a port and hold a share. Hold a port and hold a share. Come back to portfolio 1. Once again put the down here mark and write. The value of this portfolio today is, portfolio 1, right? The value of this portfolio today is, the value of this portfolio today is, tell me what is the value of this portfolio today? PC plus PV of X. Now the call value is its price and the deposit value is PV of X. VC plus PV of X. Second branch. The value of this portfolio today is, the value of this portfolio today is VP plus VS. The value of this portfolio today is VP plus VS. Is VP plus VS. Everybody understood or not? Now. Next, point number A or B? Point A or B? B. Write down. Maturity value of portfolio 1. Maturity value of portfolio 1. Maturity value of portfolio 1. Copy this particular slide. Maturity value of portfolio 1. Copy this slide. Portfolio 1, FSB more than X, FSB less than X. This is going to be the value. Shall I proceed? Can I proceed or not? Write down. Next, point B or C? C. Maturity value of portfolio 2. Finish copying, huh? Those not copy, raise your hand. Finish up, huh? Now. Point B, C or D? Point D. Okay, point D, right? Since the call option and put option, are on the same share, for same strike price, since the call option and put option are on the same share, comma, for the same strike price, and for what? Same maturity period, and for the same maturity period, comma, since they have same maturity value, comma, the present value of the portfolios also should be same. Since they have same maturity value, the present value of portfolio also should be same. The present value of portfolio also should be same. You understand or not? Since the two options are on what? Same asset, etc. The portfolios have what? Same maturity value. The present value also should be same. Last point. Point D or E? E. Hence, the put-call parity equation. VC plus PV of X is equal to, VC plus PV of X is equal to VP plus VS. Okay. Now, first of all, those who understood the discussion till now, put call parity, raise your hand. Okay, can I proceed further? Now, the question is, for examination, why should we study this put call parity? What questions can be asked in examination? What the use of doing it? Question arises now? Now, please. There are three types of questions that can come in put call parity. Okay, question number one. One of the RTP questions, simple. They will give you a value of call, a value of a share, a strike price, ask you to find out what? Value of a put option. Balancing figure, yes or no? Or they can give you a value of a put, value of the call, ask you to find out what? Share value. Or they can give you put and share, ask you to find out what? Call value. Like that. Three assets are that. Two assets value will be given. Ask you to find out the third value. A missing figure calculation, simple, straightforward. For the put call parity will be used. Point number one, yes or no? No. Second is much more interesting, important, where they give you the call value, put value, and then what? Share value, actual value in the market. You have to put into this equation. The equation will not tally. It will not what? Tally. Then what happens here? Arbitrage exists. Since the parity is absent, what is present? Arbitrage is present. They ask you to tell how to make an arbitrage profit. Is a second type of problem. Respond, yes or no? Third is, we are going to discuss in the next class, tomorrow class, lot of option valuation models like binomial, risk neutralization, two-period binomial, Black-Scholes model, etc. All this model helps you to calculate the value of a call option, value of the put option. Whether your calculation is correct or not, we should check or not. We can check the accuracy. If I put those values in this equation, the equation should tally. Otherwise, the calculation is wrong. All the option valuation model gives you the value of a call and value of a put in such a way that what is satisfied, put call parity is satisfied. Are the three uses of discussing the put call parity equation? Yes or no? All of you tell me, what are the three things that can be used in this put call parity? Number one is what? Number one is what? Missing figure calculation. Shh. Missing figure calculation. They may give you the value of call put, find out what? Value of share, etc. Number 2 is, we can test what? Put call parity, arbitrage. Number 3, option valuation model. Answer should be tallying with what? The put call parity equation, or the 3 uses of the put call parity. Yes, can I proceed? Right now, last point. Point number 4 or 5? 5. The actual value of call, comma, put, and the share, the actual value of call, put, and the share, if we put into this equation, the actual value of call, put and share, if we put into this equation, they should satisfy parity. The actual value of call, put and share, if we put into this equation, verb, okay, if we put into the equation, if we substitute into this equation, they should satisfy the parity. If parity is absent, continue. If parity is absent, what is present? Arbitrage is present. If parity is absent, arbitrage is present. If parity is absent, arbitrage is present. If parity is absent, arbitrage is present. Can I proceed? Next. Point number 6. There are many option valuation models. That helps us to calculate. That helps us to calculate call and put values. There are many option valuation models that helps us to calculate call and put values. These values will always satisfy. Tell me, that always satisfies what? Put call parity. These values will always satisfy put call parity. Put call parity. There are number of share valuation model. Can tell me any 2 models? Gordon model, Walter model. So many share valuation formulas, models are there or not? Like that for options also. Lot of valuation models are there. Whether the answer is right or not can be checked by putting into the put call parity is the issue. Okay. Now, with this we complete the introduction to this concept called as put call parity. Now, let us start doing the problems quickly in this regard. Take question number 19, please. Shh. Take question number 19. Stop talking, please. Take question 19. A put and call option each have an expiration date of 6 months, hence, and an exercise price of rupees 10. Interest rate for the 6-month period is 3%. If the put option has a market price of 2, share is worth 9, what is the value of the call? If the put has a market price of 1 and the call is 4, what is the value of the share? If the call has a market value of 5, market price of the share is 12, what is the value of the put? One of the past RTP questions. Okay, now let us start answering the problem. First question is, what is the strike price of the put as well as call option? Everybody, what is the strike price? 10. First step is to find out present value of strike price. Or no? No. This 10 is today, after 6 months. I should discount by how many months? 6 months. I should use normal discounting or continuous discounting? Continuous discounting. Now, the next question is, 3% is the interest rate given. Is a per annum 6 months interest rate. They say the interest rate for the 6-month period. Given for what? 6-month period means it is 6% per annum is what? 3% for 6 months. It is about like this given. 6 months interest rate 3% means what? Per annum. That is 6 months deposit is going to be how much? 3% per annum. One should be understanding it. In IFM, yeah, written out now. Otherwise, understand this is what an interest for 6 month period. How much percent? 3%. So e power TR itself is what? 3%. In the written out. Yes or no? Can I proceed? Now, the first step is to calculate what? Present value of strike price and then further develop the answer. Can I proceed? Write down first. Step 1. Calculation of present value of strike price. Please don't talk. I think this is question number 19. Okay, please. Step 1. What is step 1? Calculation of present value of strike price. Can I proceed? Now, present value of strike price is equal to strike price into what? E power minus TR. Strike price into e power minus TR. I want to know what the strike price? 10 rupees into e power minus TR itself is what? 3%. And R itself is given for 6 months. In e power minus 0.03. 10 into e power minus 0.03. Now, can you tell me what is e power 0.03 calculation? E power 0.03 how much? 1 plus 0.03 by 1 plus 0.03 squared by 2 plus 0.03 the whole cube divided by 6. Number 1.03045. 1.03045 is e power 0.03. I want e power what? Minus 0.03 is equal to 1 by 1.03045. Are you all following? 1 by 1.03045. Tell me the number. 0.97? 04, 0.9704. Some number, yes or no? No. In that case, present value of strike price is equal to 10 into 0.9704. Number correct apa? No. How much? 9.704. 9.704. Present value of strike price is 9.704. Enna ya purinjudha? P of X is 9.704. Can I proceed further or not? No. Finish copying, huh? Should I put the slide once again? Huh? Please. Shh. Shall I proceed? Now, let's start solving the problem. We got 9.70. Remember right or not? Now, please. Let me do it and then give you time to copy it. Okay. Now we have 3 questions. A, B and then C. Remember right or not? Now. All of you tell me part A. Part A question. What is given? Read one by one. What is given? They given you what? The value of the given, the value of the put and value of the share. Ask you to find out what? Value of the call. Okay. One by one. What is PV of X? 9.7. What is the value of the put? 2. What is the value of the call? 9. What should be the value of the share? Tell me. 9 plus 2 minus 9.7. Ennappa right or not? Because put call should be satisfied or not? It is 9 plus 2 minus 9.7. What is the value of the share here? 1.3. Everybody yes or no? Now go to second question. Now what is the given? Put value is 1. Call value is 4. Ask you to find out what? Share value. What is the value of the call? 4. What is the PV of X? 9.7. What is the value of the put? 1. What is the value of the share here? 4 plus 9.7 minus 1 gives what is the share value? 12.7. Can I proceed? Now, third question. What is the value of the call? 5. What is the value of the share? 12. Ask you to find out the value of the put. The call value is 5. PV of X 9.7. The share value is 12. What is the value of the put? 5 plus 9.7 minus 12. That gives you 2.7. Is the answer for this particular question. Everybody understood or not? Now, copy the solution quickly before you go for the next one. Please copy this quickly.